Good evening, everyone. On behalf of Asian Markets, we welcome you all to the 4Q and FY24 earnings webinar of ELGI Equipments Limited. We have with us Mr. Jairam Mohandas, Managing Director representing the company. The flow of the event is Mr. Jairam will take us through a presentation about the financials and numbers for the year as well as fourth quarter, followed by Q&A session. Over to you, sir.
Thank you, Kamlesh. Good evening, ladies and gentlemen. It's a pleasure to be with you this evening and take you through our performance for the fourth quarter as well as for the financial year. I would like to spend a little bit of time on Q4 and spend a little bit more time on the financial year. So, one second. Moving on to the Q4. This is an EBITDA reconciliation compared to Q3 and Q4 of last year and Q4 of this year. Our biggest charge has been employee cost, and out of that employee cost, if you really look at it, as part of our reorganization in Europe to realign our strategy to the realities in the market, there were some severance costs that we had incurred. It also incurred certain severance costs in India through our VRS program, so that's about 60 million. There was an increase in our employee cost to the extent of 201 million. This is basically on account of headcount increase and compensation increase. 7 to 8% is compensation increase, and the balance is headcount increase. There is nothing alarming here. It is just that we were a little challenged on our top line growth, because of which this part of our expense looks a little bloated. I will explain more about this in the full year. So going to sales for Q4 of this year, Australia, except for Southeast Asia, Europe and North America, all the entities grew compared to the previous year. So this is the reality. So it's been strong performance in India and the Middle East. So if you look at our Q4 revenue growth compared to the previous year, it's about close to 4%, and sequential growth is about 5.5%. Profitability in Q4 has been lower than the previous year for the reason that we had a one-time expense, and there was a higher other income in the previous year. Otherwise, there is nothing concerning about this performance. Our sales mix for Q4 between compressors and automotive remains pretty stable. But in this quarter, India significantly increased over the rest of the world, and that's primarily because of the drop in North America and Europe. So the consolidated financials for Q4 compared to Q3 of this year as well as the Q4 are here. So the story really is that if you look at our contribution, we have done very well. Our pricing and our material cost control has been very good in terms of our margins. Margins have been very positive. We lost out because of the increase in certain costs on people, one time as well as increments. So focusing more on the full year, if you look at the financial year, the EBITDA reconciliation, this is more a leveled out reconciliation. You see the volume growth has been strong and the contribution growth has been very strong. Employee growth cost has been high because of one is the severance has been high. A new hire and replacement was quite significant. Increase in other expenses was a marginal 53 million. So overall, if we had hit our top line quite significantly, we had looked at a double-digit growth, whereas we came in only at around 6%. So if we had hit our planned growth, I think these numbers would have got normalized. And I'll talk a little bit more about how this year looks a little later. So our net cash position is very good. We generated quite a bit of cash this quarter. So our position is about 2,140 million is what we have. So I'm going to stop here and talk a little bit about the full year and what to expect for the current year. So far, the current year has been a very positive 2 months, has been very strong. Growth has been good in India, Middle East. We have done well in the US compared to the previous year. So that's a strong thing. Europe continues to remain at the same level. We are tracking towards breaking even in Europe this year. We have taken cognizance of cost and we have strict control. Australia continues to grow marginally. Southeast Asia is kind of flat. So overall, I expect that, the margins to be continuing to be at the level that we are. And so with that combined with a pretty strong top line growth, I expect that this year that there will be a very strong performance for that. When I say this year, I'm talking about 24-25. Assuming there are no serious, political or economic uncertainties that come our way. So this is something that I wanted to share with you. And the other thing is there is a significant plan of bringing in Anwar, who has joined. He was the executive director. He's in the board. He was in the US heading the North America operations for a little over a year. Now he's taken over as the COO. He'll be responsible for all the sales and marketing of the regions as well as the back-end operations of the company. Technology, finance, HR and IT will continue to report to me. So this is part of our larger transition plan. So in terms of time frame, we haven't nailed it, but the process has started. So I will stop here and I will rely on some of your questions to clarify this further. Thank you.
Sure. Thank you, Mr. Jairam, for the commentary. I'll wait for a few minutes for the question queue to assemble. Participants, you may use your raise hand option or you may drop in your questions in the chat box and I'll take it up as and when they come up. The first question we have is from the line of Mr. Ravi Swaminathan. Ravi, you may unmute your line and go ahead.
Hi, sir. Thanks for taking my question and congrats on a good numbers, especially from the India perspective for the fourth quarter.
Thank you.
My first question is, we have seen once again growth recovering back in the India business. Past few quarters, it was kind of standalone numbers were more like flattish kind of numbers. But now this quarter, you had seen 18% growth and first 2 months commentary also has been good. So which are the largest segments which have started driving the growth with respect to the India business? And in terms of profitability, this is probably one of the highest numbers that we would have seen in terms of margins. So your standalone EBITDA margins is at 21.5%. It's way above the long-term average. So how to think about the sustainability of this profitability over the next 2 to 3 years?
So thank you, Ravi. So to answer the first question in terms of what is driving India performance during the current year, it is multiplicity of almost all the verticals have grown. But if I have to single out a few, it is construction and mining, along with water well that are driving a larger part of the growth. Our aftermarket is also driving a large part of our growth. Our industrials also is performed well. But if I have to stack them in a hierarchy, it is construction, mining, water well, followed by aftermarket, followed by the industrial. As far as the EBITDA on a standalone basis is concerned, I think it is a continuing improvement of the prices that we had set in the past. That is one contributing factor, but a marginal one, because post the COVID, changes that had the dynamics that happened, we had reset our prices. We are continuing to do a ongoing cost reduction program, which has now been institutionalized in the company for our material costs. So they deliver anywhere between 1 to 1.5% every year. So that's a program that also delivered. And the third is our product mix. The contribution of aftermarket was also a little higher, so that has also contributed to the margin. Is it sustainable? I think it is possible.
Understood, sir. And how to then what I'm looking at is international business, which I'm simply looking at as a console minus standalone kind of number. It includes ATS, LG also, but for the broader scheme of things, I would consider it's international. How to think about growth there also? There are so many moving parts there. That is one. And more importantly, just like how we had seen big leg up in margins in the India business, should we think of what we are seeing as 6-7% EBITDA margin reading as a strong double-digit number over the next 2 to 3 years?
So Ravi, if you look at the international, a big chunk of our international, close to, so if you assume 50-50 is India and the rest of the world, out of the rest of the world, 50%, close to 40% out of that 50, meaning 40 percentage points out of the 50, is US and Europe, right? Now, as far as US is concerned, it is our own internal creation. We messed up our ERP implementation, and there was a setback. We've got out of most of it. There are still some few lingering issues, but the big one is behind us. So that was otherwise we would have had a reasonably good growth in the US. So that was a bit of a challenge, which is pure internal, nothing to do with the market. As far as Europe is concerned, there are a lot of uncertainties in the market. A lot of, the economic situation is not very strong. So in spite of that, we grew. So the challenge in Europe is not, at the moment, is to sustain our top line, but more importantly, focus on on improving our bottom line by breaking even, which we think we are going to do. So if you look at a few years ago when there was a much more balance, the console standalone plus console gave us close to about a 15% EBITDA, right? When the standalone was only at around 18-19%, right? So that means the consolidated was delivering close to 12-13%. So it's possible to take it back up to that level quite quickly, right? But to get to about 20%, it is a function of larger presence and a longer presence in the market, because EBITDA comes in this business primarily from aftermarket, right? So you need to build the install base, which is what we are doing in Europe or Australia or in the US, right? Once that install base is there, we are very careful, and even now, very closely tracking and monitoring our aftermarket performance for each of our machines. So it is only a matter of time before it comes.
Understood, sir. Got it. Thanks a lot, sir.
Thank you.
So next question we have is from the line of Mr. Harshit Patel. Harshit, you may unmute yourself and go ahead with your question.
Thank you very much for the opportunity, sir. So my first question is on the European situation. While we may able to break even in FY25, but then what about our plans for the next couple of years? I mean, will we make slightly lower margins than what we were envisaging earlier when we had put the plan in motion? Because I think going by your commentary, sales are not coming through as fast as what we had envisaged. Although we may do some cost reduction, some optimization, but will it be difficult to do the kind of margins that we had earlier thought about?
So, Harshit, thank you for your questions. Now, if you really look at our plan that we made for Europe, it was not a margin-driven plan, it was a top-line driven plan, right? So we were looking at a break-even of the operations in the 5th year and making profits in the 6th year. We shifted that by a year due to the COVID period. Now, the margins in Europe are significantly lower than the US. Overall, combined margin of India and Europe put together is quite healthy, but individually as a margin in the subsidiary is lower, so the top line is the most important. So what we had done was, in hindsight, maybe a mistake. We went all over Europe except Germany, including certain markets where the pricing was extremely competitive, which is primarily Eastern Europe. So what we have done is we have reconfigured our entire sales program to focus where the markets accept our performance and pricing, right? So that reconfiguration we have done, and that's one of the reasons why our severance costs have gone up for the last quarter. So our cost structures now are pretty competitive. What we need to do is grow the top line. Now, how are we going to do that is to really look at the specific markets that we are focusing on and go deep into those markets. The opportunity is still there, but our go-to-market strategy that took us to where we are today is not going to take us to the next level. And at the moment, even as we are speaking, we are looking at a different kind of a or not different, an augmented go-to-market strategy for Europe, and we are hoping that that will create a trajectory for higher growth.
That's good, sir. Sure. So my second question is on one of our emerging business, which would be the vacuum products. I think last time in the analyst meet, you had highlighted about the licensing agreement with the DVP vacuum technology.
Right.
So how has been the start of this business for us? Have we started manufacturing any products, or have we started selling those products by importing from DVP? Where are we? And if you could highlight a little bit on what are our plans for FY25 and 26, and also how do you see the margins in this particular business vis-a-vis our base compressors business?
Okay. So the licensing process has started. The drawings have been shared, details have been shared. So the indigenization process has started. There will be exchange of people in the second quarter. So we are proceeding as per timeline for the indigenization of these products. As far as sales is concerned, what we are doing is basically incubating the market with some key customers. We are installing the fully made units from DVP, and that's to basically get customers to experience the product. So this year, that is FY25, we don't expect to see any great revenue generation. But I will come back and talk about specific revenue that we have planned for FY26 when we are ready. As far as the margin profitability of this business, so there is a similarity. The similarity is the profitability in the aftermarket. So to that extent, the vacuum business has the same profile of profitability as the compressor business. But unlike the compressor business, where the margins on equipment are relatively low, the margins on vacuum equipment is not so low. right? So to that extent, it has an advantageous thing, but the unit value of a vacuum product is much lower than a compressor. So to that extent, because we are not going to be making the systems, our system producers are going to be our customers. So we make the vacuum pump. So when you are making just the vacuum pump, the sale value of a unit is much lower than a compressor. So to that extent, the sales effort and the sales costs are a little more, but the margins are better.
Understood, sir. Thank you very much for answering my questions, and all the best.
Well, thank you. That's it.
Next question we have is from the line of Mr. Vaibhav Shah. Vaibhav, you may unmute yourself and go ahead with your question.
Yeah, thank you very much for the opportunity, sir. My first question is regarding the oil-free compressors. So with the lot of capex announcement across the electronic sector, how has our inquiry pipeline grown? And also, our supplies are to the clean room technology companies or directly to the end users as well?
So, our presence in electronics is just started, Vaibhav. When we created a strategic plan for our oil-free machines, the electronic industry was not very robust or vibrant in India. It is just starting. So our focus was on food processing and pharma, and we made some very good inroads into those industry verticals. Now with electronics, semiconductor coming in, we are beginning to get some inquiries in, but it's a long game because most of the equipment manufacturers who supply the complete systems are based out of Europe or Taiwan, and they have long-standing supply relationship with other compressor manufacturers. So it's going to be a little longer process to get ourselves homologated or included in the opportunity space. So we are working on that.
Understood, sir. Sir, my second question is related to the data center. So previously you have highlighted that we are not into the data centers. So is it due to the technological limitations? And if yes, so with the data center market growing so fast domestically, do we have any plans to address those limitations and enter into the market?
So it's not so much the limitation, it's the application knowledge, right? So we have to build that over a period of time, which we will do, right? If there are opportunities, we will certainly do that.
So sir, any indicative timeline for that?
I don't have anything specific to tell you right now.
Understood, sir. I will join back in this queue. Thank you. Thank you very much.
Just as announcement again, participants, whoever would like to ask a question, you may please use the raise hand option or use the chat box to drop in your questions. So there is a request from someone saying that if you may please upload the presentation after the conference call is done.
Absolutely, that's we normally do that. It's not a problem. We'll do that.
I have a question from Mr. Harshit Patel. Harshit, you may unmute yourself and go ahead with the question.
Thank you very much for the opportunity again, sir. Sir, you have just in this quarter announced a new capex for both screw compressors as well as the global support center. So could you highlight what would be the quantum in each of these areas? What exactly are we trying to produce here? Are these newer kind of products or just the line extensions of the existing products that we have? So just give some flavor on this particular capex.
So there are two basic. So right now, our global support center, which is our spare parts warehouse and supply center, is located in our new campus as part of our overall air center factory. Now, we have run out of space there for that, and the demand for parts globally has gone up. So we are setting up a fully automated warehouse in the same campus, for which we are investing in a new building. So that is roughly half of the 250 odd crores that we have planned. And the other is for our portable compressor, which is construction, mining and water well, which is right now produced in our city factory. We are running out of space here, and also we need space for our expansion of and new businesses that are coming in, new expansion of products. So that we are moving that also to our new campus, and that will be roughly half the value. Now, we hope we are going to start it this financial year, and we hope to complete it by March 26, well before March 26. So this is really the plan. And this is just a few calls ago, I had announced that we are making a larger plan to shift our city office to the new campus. We have made a master plan, and we will continue to keep making these investments progressively over the next probably 4 to 5 years' time, and shift all our city operations to the new campus.
So just a follow-up to that, does this 250 crore, is it part of that broader plan of 500, 600 crore, or this is in addition to that?
No, this is part of that.
That's good. Perfect. Thank you very much for the clarification, sir. I'll get back in the question.
The next question we have is from the line of Mr. Vipul Kumar. Vipul, you may unmute yourself and go ahead with your question. Vipul, are you online? I don't think so. Vipul can hear us. Participants, if you have any other questions, do use your raise hand option, or you may drop it in. Next question, sir, we have is from the line of Mr. Ravi Swaminathan. Ravi, you may unmute yourself and go ahead with your question.
Sir, thanks for taking my question. One question is on pricing, sir, pricing of products. For instance, there have been products like motors where last year there had been a bit of correction in terms of pricing. How do you see the pricing for compressors in the India market? Is it stable? Is it likely to come off a bit, or it can climb further from here? Because commodity prices like copper and all have gone up a bit over the past 1.5 months.
So copper did go up, but it's come back. It's correcting itself, Ravi. I don't see any significant volatility in metal commodity prices. So during just post-COVID, when everything went crazy, everyone corrected their prices. Nobody knew how much to correct. So different companies corrected at different levels based on different anticipation, which is what we did too. So right now, I think we are comfortable with our pricing. Is there an opportunity to increase prices? Probably, but our focus now is not on that. I think we've managed our margins over the last 2-3 years well. The focus now is to grow the business.
Understood. And with respect to mix, you might have seen the earlier cycle also. Suppose the current government continues post-election, and there is a all-out spend in terms of infrastructure spend, say, across various categories, including railways, mining, very large projects, etc. Can the mix be very much in favor of you for the larger compressors, centrifugal compressors, etc. Can that surprise on the positive side?
So, if you really look at it, the larger the machine, the less is the percentage of profitability, right? So
Okay.
you may get the top line, you may get a significant top line and a significant quantum of profitability, but the percentages are definitely lower as the machine sizes become more, right?
Okay.
Bigger, right? So the mix that really brings us good profitability is aftermarket, right? And that is not a function of infrastructure investment.
Understood.
Aftermarket comes after creating an install base and over the years, right?
Okay.
So it's a patient long game, the profitability from aftermarket. So that's the mix that really brings us. So if there is a huge increase in investment, actually the profitability will take a hit because as a percentage aftermarket will be less than the equipment.
Understood. Got it. Thanks a lot, sir.
The next question I have is from the line of Ms. Ashna Maniktala. Ashna, you may unmute yourself and go ahead with your question.
Hi, good evening, sir.
Good evening.
Sir, just wanted to understand now that our ERP-related issues are largely behind us. What is our growth outlook for FY25? We've been indicating of a double-digit growth. Some outlook, if you could share on that.
So this year we had planned that double digit, and if not for the US thing, we would have achieved it, Ashna. So we are continuing to look at that same low to mid double-digit growth for this year as well. And if I have to go by the first 2 months, I mean, the second month is still not over. We have still 3 days left. But based on what has happened so far this year, it looks like we'll be on track for that.
Okay, sir. And would that growth, can we extrapolate that to FY26 as well?
I think we should do better there because many of these corrections in many of the markets, and I expect global recovery of some of the larger economies, so we should be in a better position then. And so many of our strategic initiatives that we kicked off last year and we are kicking some off this year, they will start gaining traction. So I expect that it should be better.
Okay, sir. And sir, with last quarter, we also spoke about some of the Chinese competition being intense. So if you could throw some light on that and what is our strategy over there?
So I would say not intense in terms of, performance of the product or in terms of aggression and presence, but the volumes are going up, but more intense from a price point of view. Some of this that we don't understand. We are working on a strategy. We have already developed a prototype of a product which we believe will be a very strong answer to that segment. So it's not just the product. We also need to look at a different go-to-market because when we look at our order loss statements and reviews, we don't see too many of these Chinese players to whom we have lost orders. But we do know that from when we monitor carefully the import data. So when we look at the import data, we see how many machines have come in. So machines have come in, but we are not meeting them in the market means they are playing in a certain segment that we are not there in. So it's not just the product, but we also need a new go-to-market channel by which we can access these customers, which is what we're working on. So it's not just a product play.
Understood. So just for the sake of understanding, do we have the understanding of what segments or industry these players are catering to?
So quite a few, there's one, I mean, they're going through multiplicity of segments and they work with customers at the bottom of the pyramid who are really looking either to graduate from a piston compressor to a screw compressor, and they see that from a piston compressor to the first level screw compressor of the well-established players, the price is very high. So they're able to go and say, pitch in and say, listen, I can give you a low-cost screw compressor. That happens across a lot of industries. But there are some industries like, for instance, rice sorting, that's a very, sometimes a very unorganized segment. So there, the buyers are very extremely price sensitive. We have a good presence in that market, but for the different segment in that industry, the bottom segment, which is still quite large, is where we can see quite a bit of their presence.
Understood, sir. Thank you for the questions.
Next question we have is from the line of Mr. Shriyom Kapoor. Shriyom, you may unmute yourself and go ahead with your question.
Hi, thanks for the opportunity. I just had a quick question on aftermarket, some bookkeeping questions if you could help me with. What the aftermarket sales were in FY23 and FY24, and what kind of growth and what are current installed bases and how we can see this growing over the next 2 to 3 years in terms of volume.
Shriram, I don't have those numbers immediately in front of me, but I can tell you that in our standalone results, our aftermarket is probably around 25 to 26% of our revenue, maybe a little bit more. In our consolidated, it's probably around 14%. So that's a rough number. I don't have the numbers immediately in front of me for 23 and 24. As far as the installed base is concerned, that's a very difficult question to answer. I don't have it. We have thousands and thousands of machines in different parts of the world. So I don't have that number. I'm sorry.
Sure, that's okay. And in terms of margins, like you mentioned that the main way to improve margins would be increasing our aftermarket share. So what is roughly the current margin that you get on your aftermarket business? Was it in the range of 35-40%? What, if you could share that?
So, our aftermarket gross profit margin would be in the neighborhood of about 50 to 55%, right? That's gross profit, right, over material cost. So net at the EBITDA level, it's probably maybe 30-odd%.
Okay, thank you. That's very helpful. And so if you could just another question regarding the future in terms of the future technologies that we're seeing in the compressor market. So I'm just trying to understand the industry a little bit more. So going forward, what are the newer technologies that are being introduced in the air compressor market, and is ELGI already involved in those products? Or are there any gaps in ELGI's product portfolio that still need to be fulfilled versus competitors?
So this is a pretty stable industry. We don't see any breakthrough kind of technology changes that have happened. We would like to be the one that is disrupting this industry with some innovative products. We are working on them. I'm very confident that this year we will be introducing a technology again for the first time in the world, which could be quite path-breaking for customers in terms of the value proposition. So we are right up there in terms of understanding the know-why of this technology, not just the know-how. And that gives us the ability and the opportunity to push the envelope of product performance to the next level. So last few months, we have launched some outstanding products in our existing range itself, which makes us the best in terms of efficiency in the world. The models that we have launched, we are the best. We are number one, undisputed. So these are things that give us the market is probably a $1.5 billion, $2 billion market globally. So at the moment, we are not focusing on that. Strategically, we are looking at what could be a technology option for those kinds of applications.
Okay, thank you, sir. That's very helpful. I appreciate your responses and all the best for the future.
Thank you.
So the next question I have is from the chat box is, what was contribution of spares and services in the last quarter and last year, and where do you see it in the current year?
So I think I just answered that question in response to Shiron's question. So our aftermarket in standalone is probably around 25 to 28%. In our consolidated, it's probably around 14-15%. So yeah, that's as far as continuing that in this year, yes, it will continue down and continue to grow, but it's not going to make a leapfrogging change in percentages. There will be a creeping change in the percentage of aftermarket to total revenue.
Participants, if you have any other question, do use your raise hand option or drop it in the chat box. I'll be happy to take them. I don't see any other question coming in, sir. So I think that is what we have. Kamleshji, would you want to take over?
That's fine, sir. Any closing remarks, sir, you want to make?
Thank you, Kamlesh. Ladies and gentlemen, thank you again for your time and for your questions and for your patience. As a company, we are not happy with the results, but I don't think there is anything to be worried. This is, we believe that is just a speed bump. We are confident based on all the things that we have put in place. The first 2 months results have been also continues to be very strong. So we look forward to the future with quite a bit of optimism. So thank you. Thank you for your support. Thank you.
Thank you, sir. With that, we conclude the webinar. Thank you, everyone, for joining in. And
thank you, everyone.
Thank you, Kamlesh and Asian Markets, for hosting us as always. You've been a great support. Thank you.
Thank you.